Going up to the bank and asking for a loan sounds like a pretty simple task, right? But there are actually a few things to be aware of if you're heading down this path. Otherwise, you might face difficulties. First of all, you need to think about whether you're after a secured loan or an unsecured loan. So if the purpose of you borrowing money is to buy an asset like a car or a home, for instance, then the chances are you're heading towards a secured loan. This is one where you're pledging your asset as collateral. In other words, if for some reason you can't repay the loan, then the bank or the lender has the right to repossess this asset. This is important to know because falling late on repayments means you could potentially lose the asset that you've purchased. An unsecured loan is one which is not backed by any asset. So examples of unsecured debt include credit cards and small-sized personal loans. This makes sense because what can the lender really repossess in this case? For this reason, the lender will very likely charge you higher interest than what would be on a secured loan to compensate for the higher risk. It's important to know that an unsecured loan does not mean that you're safe if you're struggling to pay off the debt. You may receive late fees, the lender could increase the interest rate, or you could face legal action. The message here is to pay off your debts on time. Another important issue when applying for a loan is whether you want a fixed, semi-fixed, or variable rate loan. So in Australia, lenders tend to base their interest rates for loans on whatever the current market rate is, which is set by the Reserve Bank of Australia. If you are a borrower, this unfortunately can create a degree of uncertainty. So hypothetically, if you have a $10,000 loan with a 5% interest rate, each year you would expect to pay $500 interest. But let's say that the Reserve Bank of Australia increases the market interest rate, and your lender now changes the rate on your loan to 10%. Now each year you would expect to pay $1,000 interest, which is double than before. So in an environment where interest rates can change, it can be difficult to accurately forecast how much it'll cost overall to repay debts. For this reason, you may look for a fixed rate loan where you can lock in the interest rate for a set period of time, even if the market rate changes. Alternatively, you could apply for a semi-fixed rate loan. This is one where the interest rate is locked in for a period of time, for example 1 or 2 years. And afterwards, the loan's interest rate can change. Or finally, you can apply for a variable rate loan, where from day one, the loan's interest rate is susceptible to change. The third thing to note around loans is that in many cases, you might need to negotiate a repayment plan. This will lay out the timeframe in which you aim to have the debt paid off, the frequency of repayments or installments, and the amount which you expect to pay in each installment. So let's say you apply for a car loan worth $5,000 with a 4% fixed interest rate. You could negotiate a repayment plan of a 3-year time frame where you pay monthly installments of $150, including the principal and interest. This would be enough for you to pay off the loan in time. Before you finalize any loan, it's important to check with your lender how flexible they are when it comes to repayment plans. If for some reason you start finding it difficult to pay off the loan in time, it helps to have confidence that your lender can renegotiate a repayment plan if need be. And there you go, we've touched on some important things to consider before you get a lender to put money in your hands.